Peter, thank you for joining us.
Happy to.
So before we get into the nuts and bolts of financial ratios, tell us a bit about yourself. What is an investment analyst on the North American equity team? What do you do?
Sure. So there are a number of people on our team. We're about a dozen people split between managers and analysts. But in reality, all the managers are also analysts. And basically what we do is we have meetings with corporate management teams, either over the phone or in our offices, or sometimes we go to their offices, in the hopes of finding out things that you can't necessarily discover through their financial statements, and to kind of discover certain things about the business that we didn't necessarily know before. So if we can see if we think the business is investable for the long term, and if it's a business that we want to be involved in. What does that entail? So we have multiple meetings with management teams of companies we hold, and of companies we don't necessarily hold in our portfolios, but companies we think are interesting to look at or can provide kind of a read-through to companies we do hold. So we have meetings with management teams. We occasionally have meetings with sector-specific analysts who can give us deeper insights into sectors that we don't necessarily know a lot about. Maybe like the healthcare sector, where it's very regulatory-driven, or they're very chemistry-specific things where specialists might not necessarily know what drives the markets. So basically, we have a lot of meetings, do a lot of in-depth research on companies that we think are investable for the long term.
So describe your career track. How did you end up at Aberdeen?
Well, I first discovered Aberdeen when I was a junior in college. I held an internship with the North American equity team, and I graduated in 2009. Was unable to get a job in the financial markets. Went down and worked as an economist for a year, and returned to Aberdeen a year later through a rotational program that they had, which eventually led me back to the North American equity team where I started before.
And you had an internship then there as well, right?
Yes, I interned originally in 2008. That was my first exposure to the company.
And was that useful in helping you figure out what you wanted to do with your life?
Yeah, absolutely. I mean, an internship is really an invaluable experience because, they say entering college, nobody really knows what they want to major in or what they want to have as a career track. And as you progress through college, you really start to figure out what you think you might want to do. And an internship is an integral process in discovering, is this career right for me? Is this something I could see myself doing in the long term? And for me, it was. For me, it was a great experience. And, I had a great time working with the people I worked with. And I thought it was a great corporate environment. And that's what led me to come back.
So on to our investment lesson. What are financial ratios?
Financial ratios are just what they sound like. They're ratios of two different metrics that can be combined into kind of one metric to give you a sense of how a company is faring or how a company compares in terms of valuation to another company or to a broad sector. And they are metrics that can be used basically to help you compare companies across sectors or companies with competitors, or just get a sense of how companies are performing, how companies are evolving, and how companies are driving profitability.
Okay, so what specifically can they tell you about a company's performance and that company's health?
Well, there are a wide range of ratios, that cover a lot of different, characteristics of the company. So there are profitability ratios, which tell you, just what it sounds like, how profitable a company is, how much profit they make per dollar of sale, or how much profit they make, how much profit they make in relation to the assets they hold or into the equity that shareholders hold. So there are debt ratios, which tell you how levered the company is, or how much debt they have compared to how many assets they have, which kind of gives you a sense of how companies will be able to meet their financial obligations going forward, whether that be through interest payments or, if they have convertible securities where debt can become equities, and that just changes the way the company can be classified as in terms of liquidity. And then there are ratios where you can compare companies in the same sector to each other in terms of how, if one company is more profitable than the other, or if one company is fundamentally becoming better than another based on how the ratios are evolving. So they're really a means of comparison for which you really need a benchmark. Ratios by themselves are not necessarily useful unless you have something to compare them to, whether it be, historical ratios or ratios of another firm.
Okay, so how do they help in the investment world? How do they help inform investment decisions?
Yeah, well, they certainly play an integral role in in not only security analysis, looking at an individual company, but also comparing company A to company B, because they really give you that ability to say, okay, this is how the company has changed through time. You can see, are they getting better? Are they, are the fundamentals deteriorating? Are we concerned that the company is taking on too much debt, that they won't be able to service their debt load? Or you can also compare companies to each other, saying, is one company more profitable than another? Is one better managed than another? And you can generally tell that based on the company's return on assets or return on equity or gross profit margins. You can see how much kind of space a company has to improve based on how its competitors are faring. So you can generally kind of get industry trends out of these ratios, but also company-specific trends.
Is any one ratio more important than another?
Well, it depends on what you're looking at. There are any number of ratios that you can calculate. Some of the regularly used ones, we look at stuff like operating margin, which kind of gives you a general sense of how much profit the company is making. For each dollar of sales, how much of that is actually profit for the company, which is really the underlying driver, one of the underlying drivers of earnings for a company. That coupled with top-line revenue growth, or just how much sales increase every year, are really the driver of earnings for any company. But then you can also look at the company's debt to equity, or debt to total cap, which is the total amount of debt divided by total amount of debt plus equity, which tells you how much the company owes or how much its obligations are in relation to its total equity or total assets, which can give you a sense. And if you look at that and the company's income, can give you a sense of how able they'll be going forward to pay their debt, basically. The last thing you want to see one of your companies do is to go bankrupt, be unable to pay off their debts. So keeping an eye on these ratios can certainly give you a sense of, is this company going to stay profitable? Can they stay healthy? Can they maintain a normal leverage ratio? And then if you're looking at valuations, a very common one to look at is price to earnings, or P to E, which basically takes the price of the stock divided by the earnings per share. And that gives you what we call a multiple, which can range, there's a wide range of multiples in the market, but generally certain sectors will have multiples that are considered normal. And a company that's trading above normal, unless they have superior fundamental characteristics, would be expected to kind of regress towards the normal multiple. And a company that's below multiple or below normal is considered probably, a less well-run company, a lower quality company. And people would look for the company to be improving through time to kind of move up to that multiple.
Okay. So you've talked about some of the strengths. Are there limitations of financial ratios as well?
Yeah, certainly. One of the main limitations is that by themselves, the ratios don't really mean much. You have to have some means of comparison, whether it's the historical ratios from that same company or the ratios from another company or a set of companies by which you can compare. So if you want to compare company A to company B, ratios are very useful for that. But if you just look at companies A ratios at one point in time, you can't really get a sense of, it's kind of meaningless. So that's one of the biggest limitations. There are also certain things on the income statement or balance sheet that can be manipulated by management, so that don't necessarily reflect the true state of being, because there are certain ways to defer, revenues or expenses into future periods. So there are ways that management can kind of manipulate these ratios so they appear better than they are, or even worse than they are sometimes. So they're not necessarily a guarantee of the actual state of the company. So I'd say those are probably the two biggest limitations.
So all of this is a lot of information to process. And how did you learn it? I mean, basically, has it been an evolutionary process for you? You didn't step into this industry and overnight know everything. So, has there been a strong learning curve? And who's influenced your career most in that process?
Absolutely. It's an ongoing learning process, and I think that's true for myself and even for the managers who have been doing it for 25 years. I think the great thing about the industry is you really never stop learning, because there's no shortage of new things to learn. Covering, a dozen sectors and thousands of companies, there's always something new that pops up that you didn't necessarily know before. So, receiving the tutelage of people I work with, the older managers, but also people my age who know things that I don't necessarily know, has certainly been very beneficial. And just doing a lot of work on these companies and putting in a lot of time into understanding how the market works and how the market evolves over time. is certainly something that is, it's invaluable, and it's a lifelong learning experience. In terms of people who have influenced me, I mean, it's really, there could be any number of answers to that question because, all the people we work with are certainly keen to provide knowledge that they have to people, to the younger guys like me, because they know that, or hopefully we will be the future of this business going forward. So they want to impart their knowledge on us, and they want us to know everything they know about, valuing securities and valuing companies and looking across sectors and how the market works in general. But there's also a wide world of information out there away from work. The internet is really an invaluable resource. There's so much stuff on there that you can find on any given topic. There are so many great websites that you can just go check out and learn basically, most of what you need to know, at least the formulas, if not the application, for doing these ratio, analyses. And it's really it certainly is something that you feel you never can really master, just because things are constantly changing and the market's never the same from one year to the next. So even the application of the same thing can change over time.
But that also keeps it interesting.
Absolutely. Every day.
Thank you for joining us.
Thank you.